Hi, I'm Mark Rosanum, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, the Primary Vision Frac Spread Count, where we're just going to go over, what happened this past week, what do we think is going to happen going forward, and then we're going to do another recap on the Chinese data that came out and some overview on just some recent data points. We'll do the deeper dive next week. And what came out from China really kind of holds and proves out what we talked about in this past econ show. And then I did a thread on it last night, and we'll keep trying to stay on that whole debt side. But we'll connect the dots on why that matters to this conversation. So the final number for the Primary Vision Frac spread is 220. So we went up by 14. Now, what we were assuming, or at least what I was assuming, was that we were going to get a slow increase in some of the side basins, things like Fort Worth and the Cherokee. We were assuming that it was going to be a little bit of a onesie, like a one up, one down type thing. Instead, we saw a big increase in activity happen all at once, and now as they start to roll off, we'll see some of these ups and downs as we get one coming on, one coming off. So this could be a near-term high when we think about where are we going to be through the rest of April and into the first week or two of May as we work within this level. The increases came again outside of the smaller basins, but from the Permian and again from the Anadarko. So we're starting to see a little bit of that increase, but the problem is we're not seeing a big spike or at least an acceleration in the Williston or the Bakken, which is going to be a little concerning when we look at the recent declines that we've seen in production overall. But again, another 14 spreads coming into action. So here's where we can see the increase. Again, I thought we were going to have that little settle out here, a little bit of a decrease, and then maybe kind of walking within this level. But now we had that big surge as that activity comes into the side basins or the smaller basins. Protecting that decline curve, making sure they have a little bit of growth. We do, and we've been talking about how those private guys are really getting more active. But this is something that, again, kind of that little bit of a high and now start to work within this level. But when we look against last year, obviously we have now crossed that level, and we're now getting closer to where we were back, some semblance of stability. When we look at what's happening in the Permian, we're still off of where we were in 2019, but again, there's been some efficiency gains, there's been some benefits, so we're back to a point where we're going to continue to see that growth. Again, it's not going to be exponential, but it is going to be growth nonetheless when we look at production. Now that we've gotten to the point where we can hold the declines and now start to see a little bit of that growth, but one of the things that we think is going to happen now through April, through the rest of April, May, and even into June, is that we really are going to start to see some of those rigs accelerate and some of those rig counts start to continue to go up as, again, we see this frac spread count starting to flatline and plateau. Here after this big surge, we would expect to see this walk back a bit over the next few weeks, or at least hold this level within a pretty tight range. And the reason why is when we look at what's happening in terms of production, we don't want to run too far ahead, but again, those private guys continue to be fairly active. And then when we look at what is happening around the world, this was a chart that we've shown in the past, and just to look at where we are, one of the things that we've been saying was that we were going to get that recovery coming off of December, into January. But once we got to the highs that we achieved either in November or even back at the end of September, we were going to get stuck and we were going to see that go sideways. And we're seeing that now. And this is, I think, holding true to form when we look at advanced economies. Some guys come back up, like we have Canada, struggling right now. We have Japan that's having a big increase in cases as well. South Korea, obviously, we talk about India. So again, every time someone gets a little bit better, another gets worse, and vice versa. So that's really hindering and capping us here. And then China continues to see some of this walk back after that strong surge at the end of last year. just because, again, that supply versus demand, which we'll talk about in a minute. But it's important to look at, obviously housing in the U.S. remains elevated, and I don't want to spend too much time on this because we're going to cover it more in the econ show, but just wanted to look at, University of Michigan sentiment, pared back a bit. Current conditions, have gotten better, but the expectations have walked back. And it's when we look at jobs, some of the job side, because we did get a nice decline in jobless claims. We're actually now we're below the worst level of the financial crisis. It only took about 58 weeks and $8 trillion to do it, but we've done it. And what that speaks to kind of where we sit now when you look at inflation. I don't know if anybody saw, I think it was April 14th. It was not Jimmy Kimmel, but Jimmy Fallon. He did this whole thing about essentially inflation and shortages, and it was just interesting, especially now that freight waves picked up on an increase of strikes, or at least the Teamsters talking about striking and limiting, and the longshoremen coming along when we look at ports. And again, this just speaks to those supply chain issues that just continue to reverberate through the system. And now people who may feel overworked, underpaid, we're starting to see those strikes happen. So again, that inflation side continues to tick higher, especially on that 1 year, all of going above estimates. But the other side, when we look at, sentiment, it was obviously better versus prior, but still below estimates, and expectations was, expectations came in below estimates. It was expected to be 85, came in at 79.7, which is just in line with last week. And it's really being hindered by, what we're seeing in the market. But at the same time, COVID still continues to rear its ugly head. Asia Pacific is the one that we're going to talk about the most right now. Asia Pacific, if you just look at India and Asia Pacific, you can see that they're essentially the same chart. And then when we look at Japan and South Korea, we're starting to see those increases, with Japan talking about additional lockdowns, additional curfews, and now the Olympics are being thrown into question once again. All the while, Italy's Draghi is pulling forward some of the reopening to April 28th, as they continue to see a deceleration of cases, while Germany and France both struggle to right size, especially Germany, which is where they've actually talked about either increasing or maintaining some of that capacity. Now we're going to shift to the level of crude. What does it mean going on? So for those that have been following, Russia has, there's been some friction now between Russia and the U.S. We have expelled 10 of their diplomats. They have reciprocated the same situation. There's also issues within the Black Sea. When we look at the Kerch Strait, which has now been closed. So the U.S. was supposed to send 2 naval vessels. We canceled that. And I don't know, it seems the way it reads is it was done to essentially stop or not create more friction based on what is happening in the between Russia and the Ukraine. NATO has come out and said that any type of restrictions would be deemed as, not, I don't want to say an act of war, but it would something that it would hinder freedom of movements, which is why we're seeing some of these issues come up as Russia has amassed some assets along the borders here. And it's interesting when you weigh what is happening there and then what is happening within Russia at this point. So just looking at this, and then we'll talk about crude prices off of these charts. But those private capital outflows remain a pressure point when we look at what is happening within the ruble, within capital flows. They were able to get some of those bonds across when they did an offering, but it was mostly taken down by internal banks. And the friction is obviously based on what is happening between Nord Stream, sanctions, and the back and forth that we continue to see. And this is also a way to kind of deflect some of those issues, especially as the U.S. has been focusing so much on the Asian, within Asia and specifically China. So here are these outflows that continue to be the pressure when we look at the top left chart, where the average USD to ruble, then you look at the current accounts has gotten a little bit better, but private capital accounts have gotten worse. Then when we look at portfolio and FX intervention is becoming a bigger issue. And it's really when we look at what is happening with the ruble and oil prices. Now, The oil prices have obviously moved up. Brent has been strong, but their realized prices, what they're actually experiencing, has come down, which again is weighing on some of the realized situation. They've also had some shortfalls and price increases on the refined product side. So now they're talking about capping or limiting exports to protect some of the pricing and to provide some additional stimulus to the local economy, which we're seeing here. Now, just to put that into perspective, when we're looking at that bottom right chart, you have, ESPO crude was sold 3 cargoes. They were about $1 higher than they were last month. They came in at $230 to $240 premium to Dubai benchmark versus the last month for May loadings at $1.30 to $210. So we are starting to see some increases with ESPO going into Asia. But on the other side, when we look at Unipec bought 2 Ural cargoes that were actually at a discount from previous. So they this past Thursday they traded at 225, and a few days before they traded at 250. Now they're trading at 255 at a discount to 255 of dated Brent. So again, it's kind of staying within that bubble of, as we've been saying, down negative 275 to negative 225, staying right within that level. But then on the CPC side, Litasco and Chevron. So when we look at Litasco, they sold CPC for a discount of $3.25, which is a big step down. And then Chevron sold at 320 below dated Brent. Again, these are things that are becoming a bigger issue. And then India is actually seeing a bigger increase with another 2 ships heading, super VLCCs, which is the highest since February 12th. Again, so we're starting to see a little bit of movement. India's been buying a ton from, or I should say a ton, but a lot from West Africa. Again, this is where we're starting to see some of this competition, especially when we look at West African crude grades that still struggle to clear, and some of the discounts that we're seeing on Urals and CPC, while ESPO has started to see some growth. And that leads to, what are we seeing overall? So this is just looking at Singapore. We had a counter-seasonal increase in stockpiles, which is a little bit of a problem, but again, not surprising based on what we've been talking about, how we were going to start to see some of these increases in Singapore. You can see it was across the board, and just based on what is happening in India, what we're seeing out of China in terms of some slowness, especially the other parts of Southeast Asia, we expect to see Singapore to continue to climb. And now the other side, when we look at what's happening in Europe, right now we're at a 3-year low, essentially, of shipments from the Americas into Europe. It's the lowest that we've been tracking since 2018, which just means that there's going to be more distillate stuck within the U.S., which again is why the refiners are going to be focusing more on gasoline and try to limit that disti cut. But even as we have a record amount or near record amount of gasoline coming into the U.S., we still continue to see builds in Europe. And here's that counter seasonal trend as Europe not only is exporting but still recording builds, just speaking to some of the softness in the region. Now, just to put it into context, here's some India fuel sales. Now that we've continued to see some lockdowns. So far through April, everything is down across the board, especially gasoline. Gasoline had been a near-term bright spot, but that has really started to hit as shortages have been announced. People are being stressed to stay home, don't go out, because they are struggling with not only the infrastructure, but also medications. Diesel's been fairly flattish, which flattish in general, because diesel's been anywhere between negative 2.5% to about 4.5%, pretty much through every month versus the previous years. So this is just kind of holding course, where gasoline is the biggest step down that we've seen so far. Now, China demand on the other side. So in the near term, we could see some processing dip in April as the private refiners have scheduled maintenance. And again, we've also seen the government come after them and really say, so in addition to government inspection of independent operators to curb overcapacity and illegal practices that started this week, we'll continue to curtail capacity. But when we look at March, you can see where we are. We're pretty still below December and September, but getting closer to that normal. But the one thing that we've been stressing, time and time again, is that they're also increasing exports, and that's the one that we want to keep stressing. Is yes, they're increasing imports, but they're also increasing exports. So you have to look at both sides of it as they continue to take in some additional cargoes. So when we think about, okay, well, what does that look like? Well, here's the Shandong crude stocks, which you can see are still at seasonally adjusted highs. So right now, just to put it into context, CNPC sees refined fuel exports to expand nearly 32% this year to 54.7 million tons. So even though we're expected to get another about 2 to 4% increase in imports, we did get new refiners turning on, and they're all really still turning to the export market. So the other side of the equation that we continue to see is that the China Shandong fuel oil stocks are back to and approaching the 2021 highs and back to the seasonally adjusted highs. As we've seen some slowdowns, some of this will be slated for the export market, again speaking to the softness in the Singapore and other. And this is where we keep stressing the problems that we're seeing on the refined product side. Because as China exports more product, they're going to take market share. So we have to look at where is that market share going to be taken from. And it's not going to be a net increase in crude demand. It's just going to be crude going into different places and shifting flows. And now just shifting a bit to the Chinese data points. So just to simplify it, we're going to look at GDP. So GDP came in below estimates. You can see that quarter over quarter came in at 0.6% versus the expected 1.4%. So you can kind of see some of that slowness in terms of quarter over quarter. Year over year, obviously Q1 was disastrous for China, so it was not surprising to see that bump. Still below estimates. But then when we look at industrial production, all of these missed estimates by a pretty wide margin, and we'll talk about why that's important going forward a bit more. With retail sales looking better, but still March was actually slower than January and February, which is a bit more concerning with industrial production continuing to shrink a bit. So retail sales actually decreased first in January because of the local COVID-19 outbreak that we talked about and associated tightening measures, and only started to recover with month-over-month growth rates of 1.45% and 1.75% in February and March, which is much lower than the 4.5% pre-pandemic. So again, still not closing that gap, which is why that dual circulation strategy is so important for them. And then when we look at, okay, well, what is there a seasonal adjustment? So this is what we're looking at when we just look at what is the normal quarter over quarter growth between fourth and first. And it's typically at about 1.56. And here you can see kind of where that backdrop is. But it's also important to put that into context because this can also be misleading. And we want to understand, okay, well, what does this actually look like? So when we look at 2021 GDP was 10.3% higher than that of the first quarter of 2019 for an average growth rate of 5% for the past 2 years. So just looking at what it was over that 2-year period, GDP growth was 6% in 2019 and was targeted to be around 6% in 2020, which is right around this level. So realistically, Chinese GDP is still about 2 percentage points below where they should be at this point in time. And again, they're supposed to be, on the other side of COVID. But then when we look at what drove that growth, the artificial side where Beijing considers high quality growth actually shrank substantially during this period, which means that almost 200% of last year's GDP growth was represented by activity on which Beijing has been trying to cut back on, as we talked aggressively about in this past econ show about debt and the problems there. Where when we put it into numbers and context, one result of which was that last year China added new debt equal to more than 33 percentage points of GDP in order to achieve nominal GDP growth of 3% or real growth of that 2.3%. Which, again, they continue to have these non-productive investments, which is why we talked so much about this last on Thursday. And now looking at the different capacities, so you can see that we had that strong spike starting to normalize. So what does this mean? So calculations are showing that the refinancing ratio fell to 112% in December, December 2020, the lowest since 2018, and has remained below 120% since, down from 210% in the first half of 2020. Again, trying to pull that capital out of the market, trying to tamper down some of that debt. And the issue is a default at a central state-owned company like Yorong is unprecedented. And again, this comes to the bigger issue now, where during the Asian currency crisis, there were 4 bad banks that were created to take on and clean up. Yorong was one of them, and the issue is now they've amassed all of this debt, and this specific company is actually mostly owned by the Ministry of Finance, because they were trying to clean up a lot of the issues, the SOEs, and they were given preferential treatment because it was assumed it was a state-owned government organization, but now they have really gone crazy in terms of their borrowing, and has become a much bigger issue where so the Chinese, are they going to stand behind the 23.2 billion that is in the overseas market, which is why we continue to see this pressure, this focus on trying to tighten up and reduce a lot of this debt, which again is going to lead to slower growth, which we continue to see rolling out. So looking at this one is specifically on the retail sales side. So when we're looking at the numbers overall, when we annualize the retail sales at 4.2% from the first quarter of 2019, which tells us that in the past 2 years, growth in retail sales has lagged what we really should be seeing, as we were talking about that slow ramp up that has been happening, which again continues to show some of the underlying problems. But then when we look at what is going to happen going forward, the Chinese economy has in fact gone in the wrong direction since that different point. But how are they going to adjust it? So when we look at what they're going to do based on the strong consumption and export side, which they're trying to try to drive home, that's going to continue to be the focal point while they try to cut the investment on infrastructure, property, which given where a lot of these guys, politicians put their money in property, that's going to be that counterbalance that we're going to have to look at to see what is that going to be, what is that going to weigh on the overall forward view. Especially when we look at non-performing loans, where, as we talked about with Russia, we talked about with India, here's where we get those non-performing loans, which again is going to be that overhang on. It's not just a China problem, it's not just a Russia problem, it's not just an India problem, but it's a holistic issue that is going to continue to impact the emerging markets, which again leads to oil demand, and that what does that recovery look like as inflation continues to drive higher, and we continue to see some of these pitfalls, especially as some of the central banks continue to kind of tighten up and reduce some of that monetary policy. So we covered a lot. If you have any questions, please let us know. There's a lot of things happening in the world right now. We covered Taiwan last on Thursday. That's a quick update on Russia. Right now, it just seems like we're in a holding pattern right now, and we'll talk about if there's any adjustments going forward. But so far, it seems to be a bit more of a saber rattling. But we'll have to keep an eye on what's happening, and because it will be have implications to the oil markets as pretty much everything in this world does. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network, and have a great weekend.